Hi. So today in this video, I'm going to talk about what is a carry trade, right? You probably have heard about it already. If you hadn't heard about it before, probably you would have heard about it today because it's all over the news, right? On social media, but also on different news articles. It's being talked about today. It's because this is also one of the reasons why we have seen a market crash today, and it's about the carry trade on yen and dollar. So it's one of the main reason why we see a market crash today in the Japanese market, but also in the broader Asian markets, and we also see that to be the case in European and US markets as well. Right, so let's try to understand what a carry trade is, right? So this is, if you have ever studied finance, carry is a word that is often used in many parts of finance. So not to confuse, so carry trade is actually nothing but just currency trade, right? I'm not going to go into the details of the academic side of it. There is so much taught in academic finance, but I'm going to talk about it more from a common sense point of view, right? So what it is all about, right? So it's very simple to understand. Is that you borrow money from countries where you have very low interest rate, and the currency associated with that is used to borrow, and then you convert that to a currency from a country where you have higher interest rates. So you have this arbitrage opportunity in the interest rate market, right? So here is this example, right? In Japan, the interest rate for the longest time is 0%, sometimes even negative percent, right? So it's very cheap to borrow money in Japan in yen, which is the local currency, and you convert that to US dollar, and the interest rate, especially in the recent time, last 2 years in the US, is around 4 to 5%, right? And the yield on risk-free assets, the T-bills, the government bonds, is about 5%. So you easily make 5% return just by taking no risk, right? And but that's not actually true. There's a lot of risk involved here. Okay, so a lot of risk actually involved. We talk about that, but it's a easy money, right? It's more speculation, right? There's no economic activity happening here, right? So this is purely speculation based money making, right? Nobody's adding value to any economy by doing this, right? And people have been doing this for a long time. It's not very new. After the Bretton Woods system, in Bretton Woods system before 1970s, the currency market was more fixed. There was more stability in the currency market. There was more of an agreement as to what would be the currency rate or the exchange rate between US dollar and Japanese yen, or US dollar and other currencies. And there was some sort of stability, right? Not a free floating rate like now we have. It's determined based on demand and supply, and not through a fixed system, what it used to be before 1970 in the Bretton Woods system. Now in such a system, right, it's a lot risky actually to do that than people actually think it is, right? It's not easy. And I'm going to give a real world example actually. In my own experience also, I have experienced that. I'm going to talk about that a bit later, but let's try to understand how people make money out of it, right? They borrow in yen and convert that to US dollar, make money out of investing in bonds, which are very risk-free assets in the US. Some even take leverage position and invest in more riskier assets such as equities, and commodities and gold and whatnot, right? And this particular trade is associated with interest rate risk and forex risk. Okay, and interest rate risk is a very typical kind of a market risk, which is extremely difficult to predict actually. Anyone who has built models would tell you that it may sound a bit easy to forecast interest rate, but that's never easy, right? Because interest rate modeling is not just about a typical macroeconomic modeling. There are a lot of uncertainties out there, right? It's also related to geopolitics, even internal politics within the given country. So it's never easy, right? Anything happening to the interest rate can have a huge impact on the on the market, and because of which you see such a rout, right? And what happened is that central bank in the Japan has now increased the interest rate. It used to be zero, less than zero, even negative, but it has now increased interest rate, I think, by a couple of basis, I think, by a very big margin, right? It has increased the interest rate, and that has created havoc in the market, because the ones who are engaged in those leverage trades, they're panicking now, right? Because it's no longer a profitable position now, right? So you could then be, sort of be losing money, and then there is a panic selling, and because of which you see a lot of sell happening, and people want to simply get out of the trade, right? And there's simply too much of money out there, a lot of liquidity being spent on that, and a lot of these positions are leveraged position, as in people have actually gone way beyond the capacity in this in these kind of trades, and you see this happening, this having a very wider impact on the markets, even though we do not see a huge change in the macroeconomic scenarios of the major economies, right? We've seen some bad economic data, for example, unemployment data in the US, and we do see an indication of recession coming. But that's not the main reason why we see this, rout in the financial market world, right? So this is actually, this is actually causing the issue, and I'll give an example for my own experience, right? When I came to Europe, right, in 2015. I think by 2016, 2017, the interest rate was coming down, and it had already become like 1%, 1.5%, 2%, or about 3%, right? For the personal loan, 3%. And what many of my Indian colleagues, what they used to do is that they would, borrow euros and then invest in India by converting into Indian rupee, because the interest rate was so low. It was like 3%, and whereas in India the interest rate was, I think, 8-9% or even higher, especially for taking personal loan. So there is a arbitrage opportunity, and some people thought this is a smart way of investing, that you borrow money from the European banks and invest in assets in India. Fast forward 2021, 2022, things have changed, right? Interest rate has actually gone up, but the interest rate in India hasn't gone up that big way, right? The arbitrage has come down quite drastically, because the interest rate in Europe has gone up to 5%, whereas in India it's still about 8, 9, 10%. So that gap has come down. But the worst thing that has happened is that the exchange rate used to be, the euro to INR exchange rate used to be around 70 when I came here in 2015, but now it is well above 90. So there is a 30% depreciation of INR, Indian national rupee, the Indian rupee, as compared to the euro over these years, right? So even though it seemed as if it was such a wonderful opportunity back then, it's actually not that big an opportunity. I'm sure the people who had invested doing that would have made some money, but the opportunity is not as big as it seemed back then, right? Because there is a currency risk involved there, right? People who do it on short-term basis, they don't see it as an issue, because currency fluctuations are over longer period of time, not in a very short period of time. Obviously there are exceptions, right? For example, if you're talking about Turkish lira, it's different, right? But the fluctuations is quite big. But for more stronger currencies like US dollar, euros and pounds, you don't see that big of a fluctuation, and hence in short term money making is easy. That's what people think in currency debt. But Nothing is so easy in the world of finance, and especially in financial markets, which are interrelated and correlated so much that even a small thing happening in some places can actually create havoc, and there is a panic, and then people, you see have it having a impact in the wider market, and that's exactly what is happening right now, right? Some people even think it as a way of diversification, because people think that making money out of stocks, commodities, and these asset classes is not very correlated with making money out of you know uh, the carry trades. That assumption can be refuted. Actually, there is some academic literature that proves that that's not to be the case, but many practitioners believe that to be the case, and therefore they do have some position in the carry trade, right? But it's primarily a speculation thing. It is not backed by any evidence that there is some real economic impact happening in the world because of that, right? So that's almost never the case. Theoretically, it's not possible. Theoretically, what you assumes that every time there is this arbitrage, the market will make sure that this arbitrage opportunity doesn't exist in the long run, right? But that's not the case, right? If that was to be the case, if the market was that efficient, then people wouldn't be making money, right, doing these trades. But people have been making money for quite some time. But you see that not that at some point there will be stop, and that's exactly what is happening right now. All right. Now I talked about the interest rate risk, right? It's a very typical risk. Actually, it's also a risk that people are concerned with in the world of banking, right? It's one of the most difficult risk type to assess, to quantify, to model, right? Those who work in the interest rate modeling area, they know that it's sometimes extremely difficult to build good models for interest rate forecasting, right? There are academic models out there. They sound quite okay, but in the real world they may not always work. And yeah, so that's one area of quantitative finance, which is one of the most challenging one. And then these trades are also involved in the derivative space, so pricing of those derivatives also a big challenge. Nowadays I see that even alternate asset classes such as crypto, which was not the not it was non-existence I think 20 years back. I mean, a lot of the academic literature that you have is never really assumes that there is an asset class called crypto. Even that is playing also a part nowadays, right? And beyond that, you also have the FX forecasting, right? So that's also one of the one of the most complicated or sophisticated modeling area in the field of finance, right? So that's something I wanted to share with you. Simple concept. It's just an arbitrage opportunity in the interest rate market. Nothing fancy. Sounds a bit fancy, but it's nothing fancy. It's super easy. And I think anyone who is working abroad from India or less developed country, they understand it very, very well, right? You borrow at a lower interest rate from these developed countries, and then you invest your money in the less developed world, where the asset prices are growing at a very fast rate. So there is this arbitrage opportunity, and you make money out of it, right? Some people think that okay, once they make money, they will convert the currency into in foreign currency and pay it back. It's never easy. The depreciation actually takes away a lot of the profit, right? But that's still one of the easiest way of making money. I think a lot of the traders will disagree that it's quite risky. I think many traders I have spoken to, they consider it as a very easy way of making money, especially in the times where a lot of these currencies are fluctuating, and there is a lot of opportunity, especially with Turkish lira, and the other one being that in places like US, where you have the government bond paying reasonably well, very risk free. In short term, you don't see much of fluctuation in the currency market. You make quick money out of it. But unfortunately, a lot of people have taken leverage position, and that's the reason why you have such a big. It's a small market. It's not the biggest trade area, but still it's causing a havoc in the wider financial world. All right, thanks guys. Thanks for watching, and please let me know your views in the comment. See you next time.